A few years ago, Canadians were told a mortgage crisis was coming. Interest rates were rising at the fastest pace in decades. Millions of homeowners were about to renew mortgages that had been locked in at 1.5% to 2.5%. Experts warned about payment shocks. Some predicted forced sales, and others predicted foreclosures. Many expected a housing crash, and on paper, it made sense. If mortgage payments suddenly jump by hundreds or even thousands of dollars per month, something has to break, right? But here's what's strange. The crisis everyone expected never really happened. Most Canadians kept their homes, most continued making mortgage payments, and most found ways to adapt. Which raises a much more interesting question. If Canadians survive a mortgage shock, why are economists still worried? Why are regulators still worried? And why are organizations like the Bank of Canada and CMHC still paying close attention to mortgage renewals? Because the story didn't end. It just moved somewhere else. By the way, if we haven't met before, my name is Evangeline Villanueva, and I'm a mortgage broker and partner at All Trust Mortgage Solutions here in Greater Vancouver. And over the last several years, we've helped hundreds of Canadian homeowners navigate mortgage renewals, refinancing, and changing market conditions. And what I've learned is that most people are focused on the renewal wave itself, but I think they're missing what comes after. Over the next 2 years, more than 2 million Canadian mortgages are expected to renew. Many of these mortgages originated between 2020 and 2022 when borrowing costs were near historic lows. Some borrowers locked in rates under 2%, and others purchased homes at record high prices. And today, they're entering a very different world. Higher rates, higher living costs, higher uncertainty. But here's the part that most people miss. This isn't the first renewal wave. We've already gone through one. And that's why this story is so important. The first wave tested homeowners. The second wave may test the economy because many households have already used their financial shock absorbers. They've already dipped into their savings. They've already extended amortizations. They've already cut spending. They've already restructured debt. They've already adapted. The question isn't whether Canadians can survive one shock. The question is whether they can continue absorbing them. Imagine a family living in Coquitlam. They bought their home in 2021, mortgage rate around 2%, and life looked different then. Inflation wasn't dominating headlines, and groceries were cheaper. Gas was cheaper. Insurance was cheaper. And their mortgage payment felt manageable. Like many Canadians, they assumed that when renewal arrived years later, things would look dramatically different. Then the renewal letter shows up, and the family sits around the kitchen table, calculator out, mortgage statement open, coffee getting cold, and suddenly they realize something. Their mortgage payment is about to increase significantly. Maybe it's $500, maybe it's $800, maybe it's more. The exact number isn't the point. The point is what happens next. The house stays, the mortgage gets paid, but something else disappears. The annual vacation, the kitchen renovation, the restaurant nights, the newer vehicle, the extra spending. Nothing dramatic happens. There's no foreclosure, no moving truck, no panic, and the family survives. And that's exactly why this matters. According to mortgage renewal surveys, roughly 35% of borrowers report increased financial pressure after renewing. Among those borrowers, the average increase is approximately $375 per month. That's about $4,500 every year. Not necessarily enough to force someone out of their home, but enough to change how they spend money. Now multiply that by millions of households, and suddenly we're no longer talking about mortgages. We're talking about consumer spending. And this is where I think many people miss the bigger picture. Most discussions about mortgage renewals focus on whether homeowners can absorb the higher payments. But what if that's the wrong focus? And what if the more important question is what happens after they absorb those payments? Because the economic consequences don't show up immediately. They show up somewhere else. They show up in local businesses. They show up in slower retail sales. They show up in fewer renovation projects. They show up in restaurants that are a little less busy. They show up in companies becoming more cautious about hiring. So one family's decision doesn't matter much, but millions of families making the same decision at the same time absolutely does. And that's why I believe the housing story and the economic story are now becoming the same story. Here's the stat that changed how I think about this entire issue. Roughly 75% of all household debt in Canada is tied to mortgages. Think about that. 3 out of every $4 Canadians owe is connected to housing. Not vehicles, not credit cards, not personal loans. It's housing. And it gets even bigger. Canada's household debt now exceeds the size of the entire Canadian economy. Household debt is larger than GDP. That's why housing matters so much. It's woven into almost every part of our economy because mortgage payments eat first. People don't stop paying their mortgage before they stop spending elsewhere. The mortgage gets paid, everything else adjusts. Travel, entertainment, restaurants, vehicles, home improvements, retail purchases. And that's where the real story begins. The biggest surprise in all the research I reviewed wasn't the rising rates, and it wasn't mortgage renewals. It wasn't even housing prices. It was how Canadians responded. They adapted. In fact, the concern about mortgage default has actually declined in recent surveys, despite ongoing financial pressure. That's fascinating. People are feeling squeezed, yet many are less worried about losing their homes. Why? Because they've already changed their behavior. They've made sacrifices. They've already adjusted expectations. They've already accepted a different lifestyle. And that's where the hidden cost appears, the cost of survival. The economy doesn't feel those sacrifices immediately, but eventually it does, because every dollar redirected toward housing is a dollar that doesn't get spent somewhere else. And when millions of Canadians make the same decision at the same time, something larger begins to happen. And by the way, if you're interested in Canadian housing, mortgages, and the economy, make sure you're subscribed, because these are the exact types of topics that we cover on this channel. One of the most interesting findings I came across came from CMHC, because while many headlines continue focusing on mortgage renewals, CMHC has suggested that the peak of the renewal wave may already be behind us. Think about that. If the peak is behind us, why are economists still paying attention? Why are regulators still paying attention? Why are mortgage professionals still talking about household stress? Because the concern may no longer be the renewal itself. The concern may be the after effects. The renewal wave may be peaking, but the consequences may still be working their way through the economy. In other words, the housing shock may have already happened, but the economic consequences may still be unfolding. And that's a very different story than most people are hearing. That's exactly why I think that many people are still looking in the wrong place. Most people think mortgage renewals are a housing problem. I don't. I think they're becoming an economic problem. And here's why. Consumer spending drives a massive portion of economic activity. When households reduce discretionary spending, businesses notice. The restaurant notices. The contractor notices. The retailer notices. The landscaper notices, the tourism industry notices, and the renovation industry notices. One household cutting spending doesn't matter much, but millions of households cutting spending at the exact same time absolutely does. And that's where the story gets bigger than housing. Most people think that the future of Canada's housing market depends on interest rates. The Bank of Canada and CMHC seem to be paying closer attention to something else. Employment. Canada's unemployment rate currently sits at 6.7%. And both institutions continue identifying jobs and income as a critical risk factor, because mortgages don't get paid with home equity. They get paid with income. So if someone keeps their job, a mortgage renewal is often manageable. Painful, but manageable. And if higher payments collide with job loss, everything changes. That's why unemployment may ultimately matter more than rates. Not because rates aren't important, but because income is what keeps the entire system functioning. Imagine a business owner in Surrey. Maybe they run a landscaping company. Maybe they own a restaurant, or maybe they're a contractor. And a few years ago, business was booming. Customers were spending, projects were getting approved, and people felt optimistic. Today, something feels different. Not because people stopped working, and not because people are losing their homes, but because they're becoming more careful. Customers are delaying projects, families postpone purchases, and people think twice before spending. So revenue slows. Then something else happens. That business owner's mortgage comes up for renewal too. Now they're being squeezed from both sides, as a homeowner and as a business owner. This is the feedback loop that almost nobody's talking about, because when enough homeowners become cautious consumers, a housing story starts becoming an economic story. There's another issue many homeowners don't realize. Some borrowers may have fewer options than they think. Many assume that they'll simply switch lenders if they don't like their renewal offer. Sometimes it's true, but sometimes it isn't, especially for borrowers who purchase near market peaks and have seen property values soften. A new lender may require a new appraisal, and depending on equity levels, some borrowers may discover that they have less flexibility than expected. Not everyone, but enough people that it's worth understanding long before renewal arrives. Most homeowners think that the biggest mistake that they can make at renewal is accepting a rate that's too high. I don't think that's the biggest mistake. I think the bigger mistake is locking yourself into a mortgage that takes away your future options. Because if there's one lesson from the last few years, it's that things can change quickly. Rates change. Markets change, jobs change, life changes, and the wrong mortgage can make adapting to those changes much harder. And that's why homeowners navigating this environment best aren't just chasing the lowest rates. They're protecting flexibility. They're asking questions like, what happens if I need to refinance in 2 years? What happens if rates fall? What happens if I need to access equity? What happens if my income changes? What happens if I need to sell? Those questions matter just as much as the rate itself. And that's where many homeowners make a costly mistake. They receive a renewal letter, they see a rate, and they sign it without comparing lenders, without reviewing the terms, without understanding the penalties, without understanding the prepayment privileges, without understanding how much flexibility they're giving up. And the reality is that the two mortgages with nearly identical rates can produce very different outcomes depending on the terms attached to them. And that's why smart homeowners start planning long before the renewal letter arrives, ideally 9 to 12 months in advance. They're reviewing their equity position, they're running payment scenarios, they're preparing documentation early, they're evaluating whether refinancing makes sense, they're determining whether extending amortization is appropriate, and they're looking at ways to improve their cash flow before renewal rather than reacting after renewal. And perhaps most importantly, they're focusing on payment and cash flow, not just the rate, because most Canadians don't wake up asking, what's the lowest mortgage rate available? They ask, can I comfortably afford this payment? Because sometimes extending amortization may be the right short-term decision. Sometimes making a lump sum payment before renewal may make sense. And sometimes consolidating higher interest debt may improve cash flow. Sometimes switching lenders may create more flexibility. Sometimes staying where you are may be the right decision. The point is this: the best strategy depends on your situation, not a headline, not a social media post, not what your neighbor is doing. And the homeowners with the most options tend to be the ones who start planning the earliest. Because when renewal arrives, flexibility becomes incredibly valuable, and flexibility is much easier to preserve than it is to recover once it's gone. If your mortgage is renewing in 2026 or 2027, and you'd like help understanding your options before making a decision, there's a link below to book a call with our mortgage team. Even if you're not renewing for another year, sometimes the best time to start planning is before you think you need to. I don't think that the biggest economic risk in Canada is what most people think. I don't think it's simply tariffs. I don't think it's simply inflation. And I don't think it's simply mortgage renewals. Most Canadians are still finding ways to keep their homes, and mortgage arrears remain relatively low. So the real question is this: what happens when millions of Canadians successfully keep their homes by spending less everywhere else? Because when one family does that, it's a personal finance story. When millions of families do that at the same time, it becomes an economic story. And that's why I believe that the biggest economic risk in Canada isn't what most people think. It may not be the housing shock itself. It may be the economic consequences that come after it.